One of the world's largest convenience store brand has been on a certain downtrend momentum lately. So today, the real question is to know whether or not Couche Tard stock is currently under or overvalued. This is what you'll find in this video where I'll make a full stock analysis on the business Couche Tard, where I'll first start by taking a look at what is their business model, so how are they able to generate their income and what have been their latest news. And then we'll make a quick fundamental analysis followed by price prediction with different valuation models to determine what is the true intrinsic value of this business. Founded in Quebec in 1980 by Alain Bouchard, Couche Tard was initially a small store opened in Laval that had the objective to serve its local clients. However, over the past couple of decades, Couche Tard have been expanding the scope of the operations into other different provinces and other regions all across the world, which have helped them to recently become the second largest convenience store brand in the entire world by number of locations. Indeed, there are currently about 17 stores all across the world in 29 countries under their three big names, which are Couche Tard, Circle K, and Ingo. In total, by having over 150,000 employees worldwide, Couche Tard is mostly present in North America, in Scandinavia, and in Asia. Plus, as any great convenience store brand, Couche Tard is generating the largest chunk of their earnings from their fuel sales as well as from the sales of the typical convenience store merchandise, such as great snacks, beverages, grocery items, and lottery. But what is also pretty interesting about this Canadian business is that over the past couple of years, they have always been on the hunt for growing their total operations worldwide. Unfortunately, recently, despite an attempt to buy their largest competitor for around $40 billion in August last year, which is 7-Eleven, this offer has been removed by Couche Tard in July of this year because of the lack of interest from the 7-Eleven shareholders. By looking at their latest earnings report, we've also seen that their total revenue year over year have been dropping by about 5% to about $17.3 billion, which has been mainly due to an important decrease in their road transportation and fuel revenue all across the globe. And so this has led to a slight diminution of about 1% in their total net earnings that have reached about $786 million for the past quarter. With the important changes that we've seen over the past couple of years and that we are forecast to see for the next couple of decades when it comes to the classical gas cars, it can be quite a frightening fact to know that about 70% of the total revenue from Couche Tard comes from this particular segment. However, it is still important to understand that there are still many people that will continue to use their gas cars over the next couple of years. And even for those that have EV cars, they will remain dependent on charging their battery, especially when we know what is their main autonomy for most of the electric cars at the moment. It is why over the past couple of years, Couche Tard has been working on developing this new income source by implementing great charging infrastructure to generate revenue from charging fees in many of their different locations. Plus, since EV cars take way longer to charge compared to the classical gas cars, it means that people will still need to wait at the place where they will be charging their cars, meaning that at the same time, it might be a great opportunity for a company like Couche Tard to sell their other products to their consumers. But a good news for the investors is that despite struggling lately in terms of their total revenue, we've also seen that they've been able to continue to construct new sites all across the globe. But now let's see what the financial metrics are telling us about the true intrinsic value of this business. First, we can see that over the past year and a half, Couche Tard has been losing about 15% of its total value compared to what it used to be, which has also made that their price to earnings ratio has also been dropping, which could be indicating that on that regard, this company would currently be undervalued. Profitability wise, we can see that by being in a highly competitive market, Couche Tard currently have some pretty low profit and operating margin of between 3 and 6%, which are still quite higher compared to their main competitor 7-Eleven, as well as their return on equity over the past 12 months of 17%. Revenue-wise, over the same period, we can see that they've generated some revenue of close to $72 billion with some slight diminution in their latest quarterly revenue growth year over year of about 5%, and with also a slight diminution in their quarterly earnings growth year over year of about 1%. In terms of their total cash position, we can see that the company currently has about $2 billion of cash compared to a big debt of about $15 billion, where we can also see that they have a pretty high debt to equity ratio of about 97%, meaning that the company is quite dependent on the total debt that it currently has. For the volatility of the company, so how will it fluctuate through time? As always, we'll be using for a comparison the beta on a 5 years period. And with a beta of about 0.65, we can see that this company tends to be quite less volatile than the overall market, where over the past 52 weeks, we can see that the market has gained about 10% of value, while this business has lost about 7.45%. What is also interesting about Couche Tard is the fact that they also distribute a quarterly dividend of about 1.08% right now. And with a payout ratio of only about 20%, you can see that they are not using a lot of their total net earnings to pay the dividends, because instead they use most of their money to reinvest it in the company to make it grow. Now, to determine the true intrinsic value of this company, we'll be using, as always, many different valuation models, starting out with the Peter Lynch one, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide with the price to earnings ratio. And so with these hypotheses, knowing the fact that right now this business isn't distributing a big dividend, it would be indicating that the company would currently be overvalued right now. For the second model, which is the dividend discount model, unfortunately, since we can see that our average growth rate for the company is bigger than our weighted average cost of capital, it would mean that in that case, the model won't work. But now for the discounted cash flow model, where we'll simply discount out the future free cash flow of this business to find what would be our intrinsic value, we first need to find what is our WACC. So we go and we find the cost of debt, the cost of equity, the cost of debt in equity to find our weighted average cost of capital. And with this WACC, we can find that the intrinsic value would currently be indicating that the company would have a 63% upside potential, which would mean that the business would be undervalued right now. Finally, for the two last models that we'll be using, which are the Graham's original value formula and the Graham's revised value formula, we can find that according to both of these models, Couche Tard would currently be quite undervalued right now. As you've been able to see in this video, according to most evaluation models, Couche Tard would currently be quite undervalued, even if the company has been struggling a lot lately, notably with stagnating revenue as well as losing some valuation. We've also seen that their price to earnings ratio currently is pretty attractive for the investors. Plus, what I like about this business is their board of managers that is managing the company pretty well and that is always looking for great ways to expand the scope of the operations. And so it is one of the main reasons why I still hold a few shares of this business in my own investing portfolio. So now on your side, if you're looking to find what are the other companies and ETFs that I personally hold in my own investing portfolio, well, check out the video that's gonna be right over here and I will see you soon. Peace.